So guys, about our assignment, have we finished with the book yet?
Which? Yeah.
The random walk. Yeah.
Oh, random walk. Yeah, I remember. I read the book already.
Okay.
Why they call it the random walk? Because actually the future steps or the direction cannot be predicted based on the past action. This is same with in what happening in the stock market. Short run changes in stock prices also cannot be predicted. So actually we cannot rely on the complicated chart patterns, as you know that, also the expert theory, the economic prediction, even the investment advisory services, we cannot rely on it.
So I read in the book also the wording like castle in the air, and actually I'm a little bit confused about that. What is the meaning of the castle in the air actually?
Well, I think after I read that, castle in the air theory is like, who can build a castle in the air actually, right? So basically, this is about the company who try to spread a rumor, a positive rumor actually. So
by that rumor, since that the company is very good,
correct,
to attract investors to buy the shares.
It also impact the price of the shares also increase.
Yeah. After the increase and keep increase the price, so it means that everybody will follow to buy the stocks. But after the increasement process, there will be a moment that finally market realize that actually the price is too high. And after the price is too high, by the end of the day there will be keep decreasing.
Yes.
And then after keep decreasing, well, at the end of the day, the follower will be like, what is it?
Got lost just because they already bought up the price too high. They have to sell it in the very low price.
Also, there is an example in the book. I believe that there is the two cases happening in 1700th century. One case
a long time ago.
This happening in Netherlands is a tulip bulb case. Also, there is one that they call it South Sea bubble in England actually.
So what happened at the time?
Yeah, in England, South Sea is actually the British private company. They bought the government bonds, and in return, they got the right to monopoly the trade in the South Seas. So, can you imagine that the issue stock of this company is increasing from the 130 pounds sterling to 1,000 pounds sterling?
No, it's just because of the monopoly. Since
Correct,
that the company will growing and get a lot of return. And
also the enthusiasm of the investor, because they thought that this is the good investing. So, but at the time that the public realized that actually there is no relation between the price of the shares with the real prospect of the company. So soon the price of these shares collapsed and the panic reigned.
Finally they sell.
Yes. So they lost.
Okay.
So what else that we learned from this book actually? Maybe Yamak and Sarah.
Yes. I remind that in this book, the author pointed out there is two kinds of risk. First thing is that the unsystematic risk. It is related to the evaluation for the individual company. And the second risk is the systematic risk. That is related to macroeconomic, so the risk affect to the core of the market. And as we learn, we can reduce the risk with diversification of investment method. But in this diversification, it can be adapted only for the unsystematic risk.
Which is for individual company.
Yes, correct. And also, if we think about the systematic risk, we just follow the market situation. But as we indicate in the risk and the return.
Maybe you can just draw it.
Oh, okay.
Yeah, so we can learn from that.
Yeah. Okay.
if we take amount of risk as x-axis and return as y-axis, there is a so-called efficient frontier line is indicated like this. And it means that this area is a successful investment. It means if you take a high risk, there is a range of return, but the maximum return is here. And also, as I explained, there is a systematic risk. It is not depend on the diversification. So if we take the enough best diversification, we can reduce the unsystematic risk. So the line is on here. If we can get the most optimized diversification, and but depending upon the systematic risk, the return point will move on this line. When the unsystematic risk is large, they take this point for the risk, but the return is same as the optimized investment. So the difference between this point and this point would be the amount of unsystematic risk. And with the diversification, we can reduce the unsystematic risk, go to this efficient frontier line. That's the difference between the unsystematic risk and the systematic risk.
I think what I learned from this book is the author have some advices to investors, especially for new investors, random work that they don't have any knowledge or technical knowledge to invest.
Like me.
Yeah, like you. Like you should have non-investment resources, meaning like you don't need to put your invest in one basket. So you have you need to have non-investment resources. It's for the emergency, like insurance, because insurance sometimes is like investment as well. So in case you have something wrong with your family or yourself, you still have other resources for your own. And also, when you want to invest something, you have to know your objective. What actually your objective to invest? It is for long term or short term, or to take
of course
gain, or
to get
profit, only to get dividend, or to get the capital gain. So you didn't, but you have to set your risk of degree of your risk, because higher risk maybe high return. But if you don't want to take high risk, then you will get low return, something like that. And also, there's an investment here you can avoid tax legally. Because you can get investment that tax-free. Is like pension fund. Pension fund is just because when you invest in pension fund, you will not tax until it due. Like when you are already pensioned, then you have to pay the tax at that time. But maybe at that time you already old and your tax bracket is like you don't have to pay a significant rate of tax at that time. So just because if you invest in the tax investment, and right now you have a very good salary, very good income, then you will get very high tax. So
Alright.
yeah, it's like something like that. And Also, you can invest in gold.
Gold.
Yes, gold or jewelry.
Maybe we should try gold.
But you have to remember, gold or like diamond, the cost for that, what you have to store it, and you have to be careful because you have to think maybe it's because it's very precious.
The security
things,
risk.
and then security. You have the security and risk, and then you have to store it, and maybe you have to have a brown cash and something. So you have to think about the cash. But investment in gold is very good. It's just because it like even there is an inflation, the prices usually increase as well as this inflation. So it's good. It's like if there is inflation, yeah, your gold still your investment still increase. And the other thing in real estate. In real estate, because that's also increased by inflation. You can start by buy your own home, own house in the good,
we need that one.
in the good place. So you will get the gain later, maybe 10 years, 20 years, but
after we get old.
Yeah, as long as you put your investment in good location.
Okay.
Yeah. I think that's a good advice from the book.
Yeah, that's good. Yeah.
Yeah.
So gold and real estate.
Real estate is in the
Maybe it means that the unsystematic risk for gold and property will be very low.
Yes.
There is its something.
yes.
So, what do you think? As an investor, is our age affect how we allocate our asset?
Absolutely. I mean, for me, that there is classification according to the age. I mean that for the young age, let's say that for the
20s,
people under 20s, that it can take the very aggressive investment portfolio, and then at mid 50s and start to cutting back on the risk of investment, and then they start to think about the invest on the commit to bonds or stocks that can pay the generous dividends, and then after 55 that they should think about the transition to the retirement and moving their portfolio toward the income production.
There is a staging based on our age.
Yeah.
Yeah, it's just because I think if you are 20s, you still have time to take a risk, and while when you get older, you will not take high risk. You want to
Retire,
retire, and I think
enjoy your life.
Yes, correct.
Life balance.
Life balance, yes.
Alright.
Good.
So after reading all these books, do you think that you have any passion or eager to try our luck in stock?
Actually, I want to try. It's just because my job is like I have to be independent in the as an auditor, so it restricts me to do investment, especially in stock or bonds. So if we still can invest in some investment in stock and bonds, but there is a lot of form need to fill in our office. So rather than doing the much administration, so I just don't do the investment.
Yes. For me also that this is about concentrating the risk that if you play on your own by the stock monitoring that I don't have time for that. Maybe it's better for me that I consider maybe to invest in the mutual fund.
I learned from this book the importance of diversification. So as of now, I just think about one specified stock, but now I would like to try the mix of the 2 or more stocks to reduce the risk and get higher return.
Alright.
How about you, Lisa? Because you don't understand finance. Random worker.
This is something new for you, right?
How to invest.
After I read the book, so it means that my first thing to do is to find my fund manager. I will choose you guys to become my fund manager. That will be great.
Okay.
All right.
Okay then. Okay, I think it's already late. We have to go home.
Okay.
Let's go.